Hello, I'm Ben. Welcome to the channel. So today we're going to talk about Tony Robbins and talk about a recent article that was written. I look at this is talking about today's market, so it has to be fairly recent. Yep, Kellen Jansen wrote this, and this was submitted to MSN through Personal Finance. And this is an article on Tony Robbins on building wealth and what he thinks about money. So the reason I'm interested in this is a subject matter. He wrote a book a few years ago. It's called Money Master the Game, 7 Simple Steps for Financial Freedom. And this is an exceptional book. If you read 5 books on finance, this should be one of them. And once again, that's Money Master the Game, and that's what it looks like. I read this book back when I was traveling for work a good bit, and I actually started reading that late one night, and I had to go to work very early the next morning, and it got in my way a bit because I stayed up all night reading the book. But he is an expert on building wealth because he's been around for quite some time and had time to dabble in different things. But one of the things I think Tony Robbins did that not a lot of people get to do is he was a public speaker for a long time, and would get out in front of people and discuss things about the world and their business and how to impact their influence. This was before the internet. Okay, this is before there were different platforms to do it. So Tony Robbins had a lot of late night commercials and things selling his products, which some of those are still great sellers today that talk about leadership and money and things of that nature. But let's get into the 6 reasons he says the poor stay poor and the middle class doesn't become wealthy. And I think these are really good call outs. The first one, number 1, is don't lose money. And this is the thing that I've used as a measuring stick for me for quite some time. In my investments, I do invest in small businesses from time to time. My expectation is by the end of year 1 that they're making money. And so if you're in a situation where you're investing in a business that's not making money after year 1, now from startup, larger businesses, takes about 3 years to get a business built to the point that it can carry itself, especially if it's a new product and a new business. Okay, so that's one thing you take into concept. But when I'm talking about investing specifically, and this is rules more about investing the money that you make versus starting a business. Number 1 rule is don't lose money. And basically, Warren Buffett has the same expectation around that rule as don't lose money. It's comical to say that should be what you think about when you're talking about investing, but the truth of it is a lot of people put stuff in places and they just continue with it. They ride. Small business is the biggest place to call that out is, you'll say, we'll get better next month. It'll get better next month, but people aren't reviewing what it's doing. And so if you look at your P&L, if you don't have one, hire someone like myself to set one up for your business. You'd be amazed at the size businesses that run but don't actually operate on a P&L. They have something that's called a profit and loss statement, but basically a portion of the transactions are on it and a little bit of what they put in the bank is on it, but there's not a true tracking of the income. And in those type businesses, you also see the bank account is used as a slush fund. So the owners use the bank account for other things, their personal expenses, and they put all their personal expenses on the business as well. So the business P&L is not really an accurate P&L. So if you don't have an accurate P&L in your business, you can't really tell when you're losing money. And if that's the case, you need to hire someone like myself to look at those books, get that measured out, separate what is called business and what is not. And there are several things that can be called business expenses that we may think are just personal expenses. But at the end of the day, if you're doing certain things in those vehicles or using things in a certain way, there can be ways to make a tax write-off. So that can be a business expense. So number 1 is don't lose money. Number 2 is discover more stocks. Create 3 buckets of asset allocation is what he says here. Robbins says asset allocation is a major difference between ultra wealthy and the average investor. I agree with that. He advises creating 3 separate buckets for yourself. Number 1 is security. Number 2 is risk or growth. And number 3 is dream. Your security bucket will include your home, your pension, your life insurance policy, or cash equivalents that you hold. The name implies this bucket will give you peace of mind and the assets aren't subject to major price fluctuations. I agree with this completely. To the folks that say that you shouldn't own a home, Grant Cardone is one of those people. I did many of his courses because it's pretty good, a lot of good information in there, but in this, he and I disagree. Owning a home sometimes can turn the tide. For example, I was injured, 18-wheeler hit me. a few years ago, and I was going through pain, and I'm going through pain that some days is so significant that I can't do much during those days. Having the security and equity in your home will give you an option to maybe use that equity to pay for your bills or pay off things through that time period where no one else can help. And let me say this to you. As an individual, you need to realize no one else cares. No one's coming to save you. So you should make sure that you have these security investments put in place for yourself, because something could happen to you in a flash of an eye and you can't earn the way that you did the weeks prior, the months prior, the years prior. Okay, you may be a go-getter, but if you get smacked by an 18-wheeler, you're going to slow down dramatically from nerve pain, spinal pain, things like that. It's going to be significant. So having security as a bucket that you're investing into, a home, a pension, life insurance policy, injury policies. I wish I had an injury policy that was better than short-term or long-term disability, because I would still be benefiting from that policy today. Those are policies that I sell to people commonly now and say, look, this is the best option to protect yourself from accidents. Some of those policies cover your pay for those months that you're injured. So number one is security. That's life insurance, health insurance, your home, your pension. That's things you're putting away for a rainy day. Okay. Number two is risk or growth. And around that second bucket of growth includes stocks, high-yield bonds, real estate, commodities, currencies, and other assets. You're embracing volatility to a point, but you're opening the door by embracing that volatility for greater returns. So the things in this bucket are a little riskier than the things in bucket one, but taking a little bit of risk that's educated and that you actually validate that it's logical, then you go after those ways. And then lastly, Robbins says, create a dream bucket. And this is for you to have fun with. It should contain very small percentage of your net worth. Having a dream bucket can help you avoid excessive speculating with the rest of your money, but also it lets you enjoy some things now. So it can be different things to different people. For people that waste money like that on watches and cars and clothes and mansions, things of that nature, that's not what this is talking about. This is talking about small things that make it a little easier for you to do what you want to do, right? It's not talking about an uncontrolled spending. Okay, so the next one on the list is make uncorrelated investments. A lot of people talk about this. This is called diversification. Sometimes people will take diversification but end up putting all that money into the same buckets of things that they would use. Maybe it's high risk and you have losses in multiple different departments sometimes when you do that. So Robbins learned early that making uncorrelated investments while working, that every investor should hold 8 to 12 assets that don't respond to changing economic situations in the same way. He said this can reduce your risk by 80% while increasing your upside. I agree with that. For example, when interest rates go up, bonds tend to be a great buy, while stock prices usually go down. If you invest in both asset classes, you can enjoy positive returns regardless of how interest rates evolve. Other examples of non-correlated asset classes include artwork and collectibles, precious metals, digital assets such as cryptocurrency and NFTs, real estate, mortgage funds, and private equity investments. Private equity investments is where I've focused in that, but I do work with some of the collectibles and the buying and selling of collectibles as well. Note that you shouldn't invest in uncorrelated assets for the sake of doing so. You still need to research the investments you're making to ensure that you place smart bets. The idea is this is to reduce risk, not to increase it. So if these classes are putting you in multiple classes that are going to increase your risk, then you don't need to think about those things. The next is look for private equity opportunities. Robbins is a major investment in private equity opportunities. He owns stakes in pro sports teams, venture capital firms, energy companies, and other businesses that you can't access on the market. The reason he invests in these assets and advises others to do the same is they offer better returns than the standard market funds like an S&P 500. He gives the example of Guggenheim purchasing the Los Angeles Dodgers for $2 billion and then selling the team's TV rights for $7 billion soon after that. This is the kind of performance that's hard to find in market funds that anyone can purchase. The issue is that private equity opportunities are often gate-kept. You usually need to know the right people to get involved. However, if you can find them, Robbins says there's some of the most lucrative investments you can make. I agree with that. You may not have the access. I may not have the access that he has to those type of funds because of who we are, and we don't have that influence. But you can make those opportunities for yourself locally and to a smaller level. Especially if you see that someone has a work ethic that's pretty amazing or a good product. I've seen exceptional products that were just performed and executed extremely poorly. And so then they under trend markets because it's just done so poorly. Some of that's high risk too. So if you don't assess that for yourself, you need to hire someone that can assess those things. I do assess businesses professionally. It is something that I do because I don't want to put my money somewhere where the product is fantastic, but the people running the show are morons, because those people will drive your money right into the ground, will drive that product right into the ground. So there's those things too. The next, it says, consider private credit opportunities. That's what I'm talking about here. Robbins says the ultra wealthy use private credit opportunities to grow their wealth with minimal risk. This is essential. It means they lend a company money it can't get from a bank or they have too high of interest rates. According to Robbins, it's common for private credit opportunities to offer returns perhaps 9% annually, and the default rate is extremely low if you choose the right partners. Let private equity investments like these opportunities, they may be hard to find, but they're worth investing in when you see them. So this isn't going to be available to everyone. I've had people approach me about private equity and private credits. I'm doing that right now with a couple of firms. The return is strong comparatively. If you compare it to a savings account, you're not going to see anything come from a savings account. I cashed in my 401k for my primary business 2 years ago because, one, I was injured and needed some money to live off of, but two, for the prior 3 years, those things lost 14 to 20 grand a year. Now, granted, Biden was in office and you had idiots making decisions around business and finance and inflation and those type things, so it drove that money in the ground. Even though I was diversified, there were other things that even in those markets were outperforming that. So what I did was I pulled that money out of those. I took a hit for a fee and then put that money into other things, some of which were private equity, that return a greater value to me, that actually put money in my wallet, that actually put money in my accounts monthly now versus not seeing any money for a while on your money. So 401ks used to be a great suggestion around retirement. It doesn't make a lot of sense these days. In my mind, if you're moving or if a job lasts 10 years and no longer. Now, if you own your 401k and you're not doing it through the firm you work for, it can still perform very well if you keep tight on the reins. So that's the best option in doing that. Now, if you stay somewhere for 30 years, then obviously that's the best option for you, because if you leave your money in the if you leave your money in the stock market for 20 to 25 years, what history has told us is you will make money over that period of time. So it just depends on you're getting in and getting out. The final on this is the focus on providing value. Robbins says people who are most successful financially focus on delivering more value to their peers. The point is they're mostly relevant if you're going to invest in private opportunity that gives you a direct relationship with the business owners. Robbins gives an example of a friend who excels in making software as a service, or SaaS, companies more valuable. He says this friend can take a company in that industry and grow it by bringing in the right people, improving the technology, and cutting the cost. The friend has become extremely financially successful by providing this excellence and charging high fees to those who want to invest alongside him. The person earns a 2% management fee annually and 20% of each investor's profits, which adds up to hundreds of millions of dollars in income. Robbins says it's one way to become successful financially is to provide more value to your business partners and co-investors than anyone else. If you can prove that you're able to do this consistently, the sky's the limit for your financial future. I agree with that. That's what I do professionally to a small scale. This is an exceptional article. If you're interested in wealth and personal finance, which everyone should be, give his book a shot. Tony Robbins, Money, Mastering the Game. This is 7 Simple Steps to Financial Freedom. There are some pretty great examples in this book, too, about spider funds and some things you can do to diversify your income, but also the percentages that you should be putting away monthly for what and for which. That's a great suggestion in there. And in there, he mentions previous investors' thoughts on that, too, and Warren Buffett was named as well. So there you go. This is Reasons the Poor Stay Poor and the Middle Class Doesn't Become Wealthy. And if you like videos such as these, please subscribe. I have a video about that book specifically and key takeouts in the library, so you can search the videos to find that. If you're interested in subject matter such as this and videos such as these, please subscribe. I'm Ben. Be good.